If you've been told that you can't buy a house yet because you have student debt or other debts, watch this. I'll explain how lenders actually view your debt, how it affects your approval, and how you can buy a home even if your balances aren't zero. Let's talk about student loans and home loan approvals. Student loans do not automatically disqualify you. However, they are taken into account into your debt to income ratio calculation. So they do impact. What matters more is if you're making your payments on time, what the minimum payment showing up on your credit report is, and how these minimum payments will affect your debt to income ratio. If you're on deferment or forbearance, your credit report will show a payment of 0. Now, this does not mean that the lender can eliminate this liability from your debt to income ratio. We still have to qualify it in there. We still have to put it in there. But we have to use either a 0.5% for the loan balance as far as the minimum payment, or 1%, just depending on the type of program that we're going at. On an FHA deal, it's going to be the 0.5%. On a conventional, it can be 0.5% if the lender is going to be Freddie Mac. But if the lender is going to be Fannie Mae, then that would be 1% of that loan balance as your minimum payment. What are your other debts that show up on your credit report? It's going to be things like car payments, personal loans, credit cards, and even sometimes some co-signed accounts. All of these liabilities that show up on your credit report will be factored into your debt to income ratio. So the more debt you have, or the higher your minimum payments on these items are, the more it is going to eat into your approvability. The minimum payments on the credit report is what the lender is actually looking for and what we have to use for that debt to income ratio calculation, not the balance itself. So for example, if you owe $40,000 in student loans, but your payment's $125 a month, then the $125 is what we're looking at versus the $40,000 that you owe. So let's do some quick math on this. Let's say your gross monthly income is $10,000. If we're using a conventional loan, remember we have to stay under that 50% debt to income ratio threshold. So that means that your liabilities plus your proposed housing payment has to stay under $5,000 a month. How it affects your approvability is if you have these additional debts that show up on your credit report. Now, instead of being $5,000, that's going to be the total to maximize your qualification. Now we're going to start deducting. So for example, if you have a $500 car payment, $100 credit card, and then $300 in student loans, then it will be $1,000 less as far as what your maximum mortgage payment can be to still qualify for that conventional loan. In this particular scenario, as long as your proposed mortgage payment is $4,000 or less, then you will be right in the running to qualify for that conventional loan. Remember, for lenders and for mortgages, it's not about the actual debt and the balance, it's about the minimum payment that shows up on the credit report. Can you qualify for a mortgage with a lot of debt? Technically, the answer is yes. Especially with FHA and VA loans, they allow you to go higher in the debt to income ratio than a conventional loan. So this might be an option for you even if you do have higher debt. Where it hinders you is going to be in your approvability. The more debt that you have, the lower your monthly mortgage payment can be to qualify, and then ultimately will affect the maximum purchase price of the home. So some of the things that you'll want to have to make sure that you can still qualify even if you do have higher debt is to make your payments on time, have stable income, have lower credit card utilization or lower it, and you don't have any recent derogatories. Derogatories are things in your credit report like 30-day lates, collections, or charge-off accounts, which these have a big impact on your FICO score itself. So here are some tips to improve your position quickly. Pay down high interest credit card debt, avoid opening any new debt, consider income-based repayment for your student loans, and document everything clearly. The bottom line is you don't need to be debt-free in order to buy a house. Most home buyers, especially first-time home buyers, are gonna have some debt and carry some debt. It's about managing it, minimizing it, and potentially even eliminating it. Don't let misinformation keep you from exploring your options. If this video helped clear up some confusion or was helpful, do me a favor and hit the like and subscribe buttons below. If you'd like a free consultation with me, use the link in the description to schedule a Zoom call with me.